We value your time, so here is what the video will cover. You will see how gold and Bitcoin behave under inflation, interest rates, and geopolitical stress, which one protects wealth more effectively, how institutional demand is shifting, what the 2026 macro environment is likely to look like, and the key risks that people keep ignoring. By the end, you will know when gold wins, when Bitcoin wins, and why the next cycle will not look like the last one. Gold has been the default shelter for thousands of years. It behaves predictably. When trust collapses, people run to something that cannot be printed. That pattern has held through wars, recessions, and every interest rate cycle on record. The trouble is that gold's stability also limits its upside. It tends to rise slowly, fall slowly, and sit still for long stretches. It is not a growth asset. It is an insurance policy. Bitcoin sits at the opposite extreme. It is not stable at all. It reacts violently to liquidity conditions because its entire price is driven by belief in a scarce digital asset with no physical anchor. Yet every cycle shows the same thing. Whenever money becomes cheap, whenever institutions feel safe, whenever tech expands, Bitcoin accelerates faster than anything else. Its volatility is the cost of that acceleration. The interesting part is 2026. We are moving into a world with higher baseline inflation, heavy government debt, and fractured geopolitics. Those three forces usually favor gold. Investors look for safety when the global system feels uncertain. But this time, Bitcoin has matured in a way that breaks the usual pattern. It now sits on corporate balance sheets, inside ETFs, and in the long-term plans of sovereign wealth funds. Even the conservative players have accepted it as an asset class. That changes everything. In 2026, gold will behave like gold always does. It will preserve value and calm nervous investors. It will not deliver a transformational return. If central banks keep buying at the current pace, you will likely see a steady climb but not an explosive one. Bitcoin, on the other hand, is tied directly to technology adoption and liquidity. As long as interest rates begin to normalize, it will benefit from renewed risk appetite. If the next halving cycle lines up with this shift, the growth could be substantial. The decision between gold and Bitcoin is not a rivalry. It is a portfolio question. Gold protects you from monetary chaos, while Bitcoin gives you asymmetric upside when the world has to reboot itself. Gold is the shield. Bitcoin is the engine. Historically, they do not replace each other at all. They complement each other. If you hold only gold, you miss the next wave of digital value. If you hold only Bitcoin, you expose your entire net worth to volatility that can shake out even confident investors. The deeper point is psychological. Gold's power comes from collective memory. Bitcoin's power comes from collective belief. Both rely on trust, but one trust is ancient and one is modern. In 2026, those worlds collide because the people who bought gold in the 1980s and the people who built Bitcoin in the 2010s will be investing side by side. That blend will shape the next decade of wealth protection. If you want the simplest possible conclusion, it is this: gold will keep your wealth safe. Bitcoin might grow it. The smartest portfolios use both. But if you are choosing between them for 2026 alone, ask yourself one question: are you preparing for collapse or transformation? Gold answers the first. Bitcoin answers the second. If you found this useful, check out the merch, join the Patreon, or subscribe for deeper dives on technology, finance, and where the world is heading next.